All right, welcome to this explainer. Today, we're going to act a bit like financial detectives. We are going to uncover a company's true health using an incredibly powerful tool called ratio analysis. Because as you probably already know, in the world of business and investing, the surface level numbers, they rarely tell you the whole story. To see what I mean, picture this. A business just announced a record $1 billion in revenue for the quarter. Now, just looking at that massive number, it sounds like an absolute goldmine of an investment, right? I mean, $1 billion in sales is a huge achievement. It's so easy to just look at that single static number and assume the company is in phenomenal shape. But hold on a second. What if we look a little closer and realize they actually have a negative gross profit margin? What if you suddenly discovered their liquidity metrics are tanking and their earnings are actually lower compared to their equity in prior periods? That $1 billion suddenly doesn't look so hot. In fact, despite that massive revenue, they are functionally performing worse than ever. They might literally be bleeding cash just to make those sales happen. And this right here perfectly illustrates the danger of relying on static numbers. It also introduces the exact solution we're focusing on today: ratio analysis. This is simply a method of evaluating a company's true financial condition by comparing key figures from its financial statements. It's basically our ultimate tool for cutting through the illusion of big, flashy numbers to see what's actually going on. So how do we actually do this? Well, here is our roadmap for the explainer. We'll start by looking beyond the bottom line, unpack the 6 core categories of ratios, see how to analyze them over time, compare them against competitors, and then finally put the whole thing into practice. All right, let's jump right into section 1, beyond the bottom line. Think of this as a medical checkup, but, for a business. If you really want to know how healthy a business is, you can't just ask, hey, how much total money did you make? Instead, we need to ask these 3 very specific diagnostic questions. Number 1, how much money does it actually owe compared to what it has? Number 2, how much real profit is it squeezing out of every single dollar of sales? And number 3, how quickly does it sell what it buys? By comparing these specific relationships, we finally get to see how the engine is running under the hood. And honestly, the best part? You don't need to be some Wall Street insider to figure this out. Every single figure we need to calculate these vitals can be found right in the company's core financial statements. We're talking the balance sheet, income statement, statement of cash flows, and the statement of shareholders' equity. These publicly available documents are basically our diagnostic charts. Moving right along to section 2, the 6 ratio categories. These are literally your business's financial vital signs. So we can break all of these metrics down into 6 distinct buckets, and each one gives us a totally different angle on the business. Liquidity ratios look at the immediate future. Can you actually pay your short-term debts? Solvency looks further out. Can the business survive its long-term debt loads? Profitability, as you'd guess, tells us how well they generate actual profits. Then we've got efficiency ratios, which show us how well they use their assets, like inventory turnover. Coverage ratios check if a company can comfortably make its interest payments. And finally, market prospect ratios, like the famous PE ratio, help investors predict future earnings and stock value. Let's actually zoom in on 2 of these just to see why grouping them matters so much. Notice the stark contrast here between liquidity and solvency. Liquidity is strictly checking if a company can survive today using its current assets. Solvency is measuring if it can stay afloat over the long haul. A company might have amazing liquidity today simply because they just took out a massive loan, but their solvency ratio, it will look terrible, warning you of a long-term disaster. You absolutely need both perspectives.
Okay, section 3, analyzing ratios over time. This is where we start spotting the trends. Because here's the thing, a single ratio calculation is basically just a snapshot, right? But tracking them over time, that's the whole movie. By calculating a metric, let's say inventory turnover, at set intervals, we can map out a distinct trajectory. You start with a baseline in Q1, you track the rate of change in Q2, look for those planned improvements in Q3, and boom, by Q4 you have a crystal clear picture of the company's growth trajectory. It tells you exactly where they are going, not just where they are.
But, and this is a huge but, you have got to watch out for seasonality. Temporary fluctuations can completely skew your month-over-month data and trigger a false alarm. For instance, a retail store's inventory turnover is going to look massively different in December compared to July. You always have to make sure you're comparing apples to apples when looking at time series data.
Next up is section 4, comparing competitors and benchmarks. Because, as we'll see,
Context is literally everything.
Check this out. If company ABC is pocketing 50 cents of profit on every dollar and company DEF is only keeping 10 cents, comparative analysis makes it super obvious who's running a tighter ship. But look at the PE ratio. Investors are paying $100 for every dollar of ABC's earnings, but only $10 for DEF's. Ratios let us weigh that extreme operational efficiency against how expensive the stock actually is to buy.
Now, here's your golden rule for this. You can only analyze similar companies within the same industry. Different industries have entirely different capital structures. A massive debt-to-equity ratio might be totally normal for a utility company building a billion-dollar power plant. But that exact same ratio, it would be an absolute death sentence for a software startup.
And it's not just about beating the competition either. Companies are constantly measuring themselves against internal benchmarks to force operational growth. But there are external pressures too. Lenders set incredibly strict benchmarks like debt service coverage requirements to maintain cash flow loans. If a company's ratios drop and they violate those loan covenants, their loans can actually be recalled immediately.
All right, let's bring it all together for our final section, putting ratios into practice. Let's look at the bottom line.
Okay, if you only remember one thing from this entire explainer, please make it this warning. Ratios can never, ever be used in isolation. You absolutely need context and combination. If a company generally has solid numbers everywhere, but then you spot a sudden unexplained weakness in just one ratio, like their quick ratio suddenly plummets, that can spark a massive stock sell-off. Why? Because it signals an underlying crisis that the static numbers are hiding.
We've also got to be realistic about their limits. Let's be real. Companies absolutely can and do manipulate minor variables to make their ratios look pretty right before an earnings report without actually fixing their underlying financial fundamentals. That is exactly why ratios require combination with other metrics, and you always have to weigh them against non-financial information, like management changes, new competitors, or shifts in consumer behavior. At the end of the day, when you use them right, ratio analysis basically connects all the dots. It makes total sense of those dry financial statements by comparing related numbers to expose the real trends, the genuine strengths, and those critical warning signs you would completely miss if you were just staring at top-line revenue. Which leaves us with one final thought to ponder as we wrap up this explainer. If $1 billion in revenue can be nothing more than a dangerous illusion, what hidden truths or red flags might a quick ratio analysis uncover in your own investment portfolio today? It might just be time to pull out those statements and start calculating.